Hello. Today we're diving into an analysis of one of the most undervalued dividend stories in the market, Microsoft. When most investors think about companies with growing dividends, Microsoft rarely tops their list. But that's a huge mistake. Under the hood of this tech giant lies an exceptionally reliable dividend machine that has been quietly increasing shareholder payouts for over 2 decades. Today, we'll run Microsoft through our proven five-pillar formula MaxDividends, a systematic approach to identifying companies capable of consistently increasing sales, protecting margins, maintaining strong balance sheets, and raising dividend payments year after year for decades. Let's understand how transparent and clear is Microsoft's earning model. This company has built an empire on products that are virtually impossible to abandon. Every day, millions of users work with Word, Excel, PowerPoint, or check email in Outlook. Organizations and government structures worldwide pay subscriptions for these solutions, and after implementation, clients extremely rarely switch to competitors. Microsoft created the most powerful cloud platform, which has become the foundation of the modern digital ecosystem. From young tech startups to Fortune 500 corporations, everyone uses Azure to launch applications, store information, and implement artificial intelligence solutions, generating stable recurring revenues. Add Windows, the Surface device lineup, and the Xbox gaming division, now strengthened by Activision blockbusters, and you get an ecosystem that retains users for years. The genius of this model lies in diversification. Microsoft doesn't depend on one product or geographic market. Cash flows come from software, cloud services, devices, and games, with most being recurring and predictable. Our philosophy is simple but effective. We focus on sustainable quality enterprises that consistently increase dividend payments. The longer the ownership horizon, the more passive income accumulates steadily, predictably, and without active management. This is the magic of compounding in our approach. First filter, dividend history. Our basic criterion, companies with more than 15 years of continuous dividend growth history. Microsoft started with payouts in 2003 and has increased dividend amounts every year since. Over the past decade, average annual growth was double-digit, and in the current 2025, management announced a 10% increase. Such a track record makes Microsoft a true dividend eagle with 21+ years of growth and clearly positions the company on the path to dividend aristocrat status, an elite club with 25+ years of continuous increases. Second, applying the five-pillar formula. Revenue dynamics, foundation of strong business. Over the past decade, Microsoft's revenues more than doubled from less than $100 billion in 2015 to nearly $250 billion in 2024. This is sustainable compounding growth driven by Azure success, Office 365 subscriptions, and enterprise contracts. First pillar passed. Powerful long-term demand driving expansion. Operating profitability fuel for dividend growth. Operating profits developed in sync with revenue. Operating income reached over $150 billion in 2024 while maintaining stable margins thanks to the high-margin software model. Microsoft isn't just increasing sales volumes, the company maintains healthy profitability. Second pillar passed. Profitability scales with revenue. Net income true strength indicator. Net income grew from approximately $13 billion in 2015 to over $90 billion in 2024. Even during periods of global turbulence, COVID pandemic, interest rate hike cycle, inflationary pressure, Microsoft demonstrated stable profitability. This resilience attracts dividend investors. Third pillar passed. Reliable ability to generate profit through various economic cycles. Dividend payout reliability protecting passive income. TTM payout ratio about 24%. 5-year average approximately 29%. This is a conservative level. Microsoft could double the current dividend and still have significant resources for reinvestment. Dividend policy safety here is at maximum level. Fourth pillar passed. Exceptionally safe payout with growth potential. Debt sustainability, avoiding financial risks. Debt load coefficient stayed below 0.7 for a decade, supported by massive free cash flow. Microsoft has certain debt obligations, but they're insignificant relative to the powerful balance sheet and cash generation. No warning signals. Fifth pillar passed. Minimal and excellently controlled leverage. Company's financial stability. Financial scoring 90 plus works as express diagnostics of any business health. The higher the indicator, the stronger and safer the company. Scoring 90 plus signals that the business is fundamentally sound and designed for long-term perspective. According to our 5-pillar formula, Microsoft is classified as a solid dividend eagle, impressive history, reasonable payout policy, and substantial safety margin for future development. Investment strategy. Not every dividend stock solves the same tasks, and this is the art of building a purposeful portfolio. Some companies are optimal for capital growth, others provide balance between growth and yield, thirds specialize in generating stable current income. This is exactly why we developed Max Ratio, a simple metric that helps MaxDividends investors break through information noise and quickly understand a stock's true value. Max Ratio analyzes 3 components: current dividend yield, dividend growth pace, and overall financial sustainability. Growth eagles with Max Ratio below 4, capital growth priority. Current dividends may be modest, but they confirm business profitability and sustainability. Balanced eagles with Max Ratio 4 to 8, optimal combination. They provide income today and steadily increase payments annually. Income eagles with Max Ratio 8 plus, cash flow machines. High yield positions that provide meaningful income immediately. With Max Ratio 1.59, moderate yield but double-digit dividend growth and fortress-level finances. Microsoft represents a classic growth eagle. You acquire this stock not for today's income, you hold it because it expands, dominates, and accumulates capital, while dividends quietly strengthen the overall strategy. Comparison with industry competitors. Not cheap by industry standards, but premium is usually justified. Microsoft appears as fairly valued trades at roughly adequate level relative to competitors. Comparison with historical valuation, somewhat expensive by historical standards. Over the past 10 years, Microsoft shares usually traded around 31 times earnings. Currently, it's 37, indicating the stock is more expensive than usual level. Current yield versus historical levels. Yield below historical norms. Today's dividend yield is approximately 0.6%, which is actually below the 10-year average of around 1.3%. Certain capital growth potential above dividend growth. The stock trades around $420 per share. Analyst price targets concentrate in the $460–$480 range, suggesting roughly 10 to 15% growth. Microsoft cannot be called undervalued in the traditional sense. It trades at a premium. However, this premium reflects world-class finances, fortress safety, and long-term dividend growth prospects. It's a fortress-level growth eagle, and it belongs on their list as a high-quality business designed to drive capital growth for decades ahead. The same simple principle we applied to Microsoft works for any stock. No extra noise, only clear steps that allow determining whether a company truly matches your plan. And the best part? This isn't just theory. Everything is already integrated into the MaxDividends app. Financial scoring, Max Ratio, top dividend eagles list, and even our personal lists. MaxDividends is a real treasure trove for dividend investors of any scale and focus. Whether it's growth, balance, or pure income, tools and community support are available here. If this analysis was helpful, support with a like and subscribe to the channel and community. I remind you, this is not investment advice. Always conduct your own analysis before making financial decisions. See you in the next analysis.